Hi everyone, before you invest a single rupee into corporate bonds, stop. Because most people don't realize that you can lose money even in something that looks perfectly safe. Today I'm going to explain the three biggest questions every investor needs to know before touching corporate bonds. Can you really get your money back anytime? Does your capital depend on interest rates? And how do taxes compare with stocks? The answer to these can completely change your investment strategy. Let's start with the biggest misunderstanding, liquidity. You've probably heard that bonds are safe and stable, so you assume you can just buy a corporate bond and sell it anytime, just like a stock. But here's the reality. Imagine you walk into a shop where only two or three customers show up the whole day. You might be selling a perfectly good phone, but if no one is there to buy it, you either wait endlessly or accept a much lower price. That's exactly how the corporate bond market in India feels. There are fewer buyers, fewer sellers, and very low daily trading. Yes, technically you can sell your bond anytime, but practically the question is, will someone buy it from you at the price you want? Many times the answer is no. Government bonds behave differently because their market is huge, but corporate bonds, especially private company bonds, often trade very rarely, so liquidity is not guaranteed. Now, the next question, does your return of capital depend on interest rates? Here's the simple explanation. If you hold the bond till maturity, you get back the face value. That is fixed, but if you sell before maturity, the price behaves like a seesaw. When interest rates in the market go up, the price of your bond falls. When interest rates fall, your bond's price rises. Think of it like a movie ticket. You bought a ticket for a popular movie at a normal price, but suddenly the hype around the movie increases and everyone wants to watch it. Now people are willing to pay extra for your ticket. That's like interest rates falling, but if the movie gets bad reviews, suddenly your ticket is not worth the original price anymore and you may have to sell it at a discount. That's what happens when interest rates rise. Let's simplify it with numbers. Suppose you have a bond paying 8% interest. After you buy it, new bonds in the market start offering 9%. Why would anyone buy your 8% bond unless you give them a discount? That discount comes out of your capital. But if new bonds offer only 7%, suddenly your 8% bond is more valuable and you can sell at a profit. This is why return of capital is affected only if you exit early. If you hold till the end, interest rate changes don't matter. Now let's talk about taxes, which is where the surprise hits most people. Corporate bonds give you interest every year, and that interest is added to your regular income, which means it is taxed according to your income slab. If you are in the higher slabs, almost one third of your interest can disappear into taxes. If you earn 80,000 in interest, you may actually be left with only around 56,000 after tax if you're in the top slab. Compare this with stocks. Long-term gains on stocks are taxed at 10% after your first 1 lakh of gains. Short-term gains are taxed at 15%, and this is usually far lower than the slab rate most salaried individuals fall under. So from a tax perspective, stocks are significantly more efficient. Think about it this way. If a bond gives you 9% returns, but you lose 30% of that to taxes, your effective return becomes roughly 6.3%. Meanwhile, a stock investor may make 10 or 12% and pay only 10 to 15% tax on the gain. Over years, this difference becomes massive. So, which is better, corporate bonds or stocks? Here's the simplest way to think about it. Corporate bonds give you stability but not flexibility. They give you fixed income but not great tax efficiency. Stocks give you volatility, yes, but also better liquidity and much more tax-friendly growth. If your goal is predictable income, corporate bonds make sense. But if your goal is long-term wealth creation with better post-tax returns, stocks usually win. To sum it up, corporate bonds are not bad, but they are misunderstood. You can exit them, but not always easily. Your capital is safe only if you stay till maturity, and taxes can reduce your returns more than you expect. Understanding all of this helps you make smarter decisions that match your goals.